This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and begin looking at some of the examples that we have with regard to our working capital and liquidity. So the first one that we've got here is just the standard multiple choice question and asking us to determine which of the following statements is correct. So one of those, A, B, C, or D, is correct. Okay. Have a go at the question first yourself if you haven't done so already. If you have done, carry on listening. If you haven't done the question, stop and work the question yourself first. Don't just listen to me. You need to be able to get used to practicing these questions yourself and then to learn from any mistakes that you make. So let's go through and have a look at them. A, B, C, and D. So it says Zena's liquidity and working capital has improved in 20x9. So we're going from 20x8 to 20x9. And effectively what you've got there is those ratios, the four of them. The current ratio is talking about your liquidity. And we can see there that the ratio has gone from 1.5 to 1.2. So the liquidity hasn't improved. So it's definitely not A. Likewise, the working capital hasn't improved. Remember, your working capital cycle is receivable days plus inventory days less payable days. So if we were to work that out for each of the 2 years, I think you have 87 days. Is that this year? 75, 30, 45, 87. And then is it, double check, my arithmetic's not great. 45 from 50 is 5 plus 35 is 40 days. So working capital has got worse as well. So it's definitely not A. Neither of them have improved. B, Zena is receiving cash from customers more quickly in 20x9 than in 20x8. So if we go through and have a look there, as my pen decides to call it a day. The joys of technology. Give it a quick shake. See what happens. There we go. Spring the battery back into life. It's magic. You either turn it on and turn it off, or you go through there and just give it a shake. Here we go. Brilliant. Anyway, where were we? B. Zena is receiving cash from customers more quickly in 20x9 than in 20x8. So that can be determined from my receivable days. And you can see there that our receivable days in 20x9 are 75 compared to 50 in 20x8. So that is showing that it takes us longer to get the cash in. So it's not more quickly, it's much more slowly. It's taking us 25 more days. C, I think it's the right answer. Zena is suffering from a worsening liquidity position. That's true, because the liquidity is reflected by our current ratio, and that current ratio has fallen. So it's definitely C. It can't be D. Let's just double check. Well, it says Zena is taking longer to pay suppliers. So that will come about from our payable days. And if you look at our payable days, it's gone from 45 down to 30 days. So we are now paying our suppliers in 30 days when previously it was 45 days. So we're paying them 15 days quicker. So it's not taking us longer. It's actually taking us much quicker. So that example, the answer there is C.